markets and why they're apparently shrugging off the latest news is Senior Derivatives Team Manager Kevin Green. Welcome back, Kevin.
Hey Nina, how are you doing today?
I'm doing all right. It was just a stressful weekend here in Chicago, listening to the news reports and also just getting reports from my friends about what's going on in their neighborhood. And actually, a few of them did attend, some of the protests. And of course, they went home because we did have that curfew. But just hearing the news stories was just, pretty tough weekend. Now,
Yeah, and
today, yeah, it's been tough. And listening to the news, the markets are up today. So we're going to be talking about some different indexes, some different stocks. We'll also talk about some options, strategies at the end of today's program. So any stock symbols that I do share with you today, they're being shown for informational purposes only. It's not intended to portray any type of recommendation to buy or sell any particular security or to put on any strategy. It's just so that you get more familiar with what's going on in the markets and get more familiar with, how to use these different tools and features that are available at Schwab. Now, at the end of today's session, we're going to take a look at a couple of stocks that are actually going to be reporting earnings this week. So any option strategies that we look at, we'll actually be focusing on the option straddle, but anything that we share with you, it's once again being provided for informational purposes only. And before you consider opening an options account, please carefully read through the options disclosure document. A link to that very important document is available at the bottom of this web page. All right, so let's get started. Let's go to, here we go. So I'm in my demonstration account. We're on Street Smart Edge. And most of today's session will be spending here under Launch Tools on the charts. And then later on, we'll take a look at the options chains, which are on the all-in-one trade tool. And then we'll also take a look at the economic calendar and the earnings calendar. All right, so we can see what's on the docket for this particular week. Now, Kevin, we could see that the S&P 500 right now, it's up 0.5%. And this is now the fourth day that we've been above the 200 simple moving average, which is that light blue level right here. So, what's one of the reasons why, we had this bad news over the weekend about what's going on in our many of our major cities? What's one of the reasons why the market is, probably up today?
it's a really good question. I really believe that the market overall is really pricing in the next 6 to 8 months, and it's a forward-looking indicator. Obviously, it does move because of current events that are going on right now, but the market really is focusing on what is going to happen in Q3 and Q4, and it looks like it's really priced into that in the marketplace as of right now. So we do have a lot of turmoil within the country right now. A lot of things are going on between COVID and some of the protests that is out there, but there's increased optimism that consumer spending is going to be back up. We are going to be able to chip at the unemployment rate and hopefully get more people employed within Q3 and Q4. So I think the market overall is just pricing that in. We don't also want to shy away from the fact that the market is also looking at what the Fed is doing as well. The Fed has really propped up this overall marketplace by not only its rhetoric, but the actions that it's taking as well. And they're, with the old adage that you never want to bet against the Fed. And I think the overall marketplace is doing exactly that. It's actually looking at the Fed as taking action in a positive light, and they're buying up on the opportunity there. So that's overall really what I look at as far as the marketplace. I was a little bit surprised that we are up today. I thought we may have a little bit of a sell-off, but it's always forward looking, so the market's always correct, right?
Right, right. Definitely, I agree with what you said. I mean, the marketplace is looking at, we've had just this huge amount few days away from making its first loan. And also, if we take a look at gold a little later, you know, Fed Chairman Powell was talking on Friday, and he's a bit less tense about what's going on in the economy. But what he's worried about is a potential second wave of the coronavirus. And that's one of the latest news stories that you're hearing today with the amount and the size of the protests that we've had, that there has not been social distancing going on. And so that could, just add some insult to injury on the number of people that are infected by COVID-19. But definitely reasons for the bull market. We've got a huge amount of stimulus coming out of the Federal Reserve. And also another thing is, because there's so much stimulus out there, like these, and they're out there, they're buying these assets, and they're also buying bonds, and that is lowering these yields out there, these low bond yields, which means a lot of traders and investors, they have they don't have a lot of choice, many of them, but with such low yields that they're just piling into stocks. So that's another reason. And as you said, many traders are very optimistic about the opening. Now, in my neighborhood, I live in Chicago, I live in Lakeview, which Wrigleyville is part of it, and there's a lot of restaurants down my street, and they were going to block off the street for a couple of, actually a huge, from Diversity all the way to Belmont. They were going to block that off on Broadway from car traffic, and they were going to allow all of the restaurants to actually open up and have seating outdoors. But the thing is, it is kind of rainy sometimes in Chicago. I don't know how great that will be, but nonetheless, because of what's been going on in the city, I don't think that these restaurants will start reopening this week. Maybe they will, but I could see that this could kind of delay the opening that we're seeing in other parts of the world, of course. Germany, Italy's opening up, Spain's opening up, and you were also mentioning that China is opening up as well, and some of the companies that are out there. I believe you were saying Marriott, correct, is opening up. Let me just show you some of the companies that are in that reopening trade. Here's Marriott.
Yeah, Marriott's very interesting. So they actually did open up all of their China hotels. So obviously that's going to be a revenue stream for them as they continue to reopen. But we are seeing a little bit of a pop in the stock as well. One of the things that I thought was very interesting, is the outlook for this year when it comes to travel. So it doesn't mean that Americans are not going to travel as much, but it means that they might adjust their travel plans. So maybe going from taking a trip overseas to taking more domestic type of travel plans. And then also benefiting from that is going to be the hotel chains and also some of those restaurants as well. So it might be a little bit of an interesting market to be able to look at when you're seeing opportunities for a reopen type of trade. We've not only seen a jump when it comes to the hotel and hospitality stocks, but we've seen a little bit of the jump in the cruise liners as well. But overall, they still are going to have a little bit of headwinds out there. But Marriott's a very interesting one. You also have Wind Resorts up as well. We're also seeing a little bit of a bid for them today.
Right.
So
And you mentioned, as you were talking about the cruise lines, Carnival, Norwegian Cruise Line, and Royal Caribbean. I mean, they were up quite a bit last week as well. And let me just sort by industry here. And let me pop up Carnival Cruise. There we are. Okay, they're low. Okay, they're listed under hotels and leisure. I see. There's Carnival, and yeah, they were up over what 4% last week alone. And also the airlines have definitely caught a bit. So last week we saw the cruise lines, the hotels, and American Airlines, Delta, and United Airlines. And let me make sure that we've got those on this list as well. Here's United Airlines. Let me move it over here. Let's see what they're doing today. There's United. They're up 4% as well. And JetBlue is what JetBlue I should put up there as well. Forgot the symbol for JetBlue, JBLU. There we go. Start typing it in. There you get the suggestion. Add it to the list. Let's drop down below. You can see JetBlue. Well, they're not up all that much. All right, now let's take a look. Now, what levels, when it comes to the SPX, what levels were you looking for? Because we were talking about that 200-day for quite some time, and I know you were focusing on that 3,000 level for the SPX as a psychological level. Do you find that this level will now be support?
I believe so. I think the 3,000 level is going to definitely be support, and I still have it as my lower support area that is out there. But when I'm looking at the overall market, Nina, it's been very resilient compared to the news that we've had, as compared to the economic data that we have seen, and even some of the projections that we have seen forward. That being the case, wouldn't surprise me if the marketplace, and once we have Q3 and Q4 earnings, is accepting and actually maybe even catching another bid for some of the earnings that does come out from some of these companies that are pulling earnings guidance for the year, because at this point in time they're trying to make sure that they don't have any real expectations on what to report. So everything that they report could potentially be of a bullish sign. The only thing I could see the market right now actually having a little bit of a sell-off, just because of the trends that we have seen, is continued tensions between the U.S. and China. We did see that on Friday. The U.S. basically has considered Hong Kong to not be a independent body, and now is a dependent body of China now, which is also going to impact some of the budgeting and funding mechanisms that we have in place, some of the agreements that we have in place with Hong Kong. We did see a little bit of a retaliation today. It sounds like China could potentially tell their importers to not purchase U.S. agricultural products at this point in time, as a response to the moves that we made on Friday. So if we see those tensions continue to flare up, and we see an actual breakdown in these trade commitments, I only maybe not call them a deal, but trade commitments, that might send the market overall lower. But at this point, it seems like it's shrugging off a lot of the negative news that we've seen in the last 3 to 4 weeks.
So not only have we had to deal with COVID-19, but these China tensions are reappearing once again. But the thing is, a lot of traders really, sighed some relief on Friday, because they were worried that President Trump might actually pull out of the phase one deal that they reached earlier in the year. Now, there was some positive news also out of China, too. China's manufacturing activity actually expanded in May, and they were expecting actually a lower number. They were expecting a little bit of a contraction. So the actual PMI was 50.7, and that's up from April's 49.4, which is better than the 49.6 that's that's expected. Um, but we definitely have to keep monitoring the U.S.-China tensions for sure. And also, in regards to China's, handling of the COVID outbreak to begin with. President Trump has had some issues with that, so that will probably reappear. All right, let's take a look. Let's go to the actual calendar. Let's go to schwab.com, and then we could click on actually and research, for instance. And once you're on research, you simply go to the calendar page. Let me show you how to get that. Click on research, then go to calendars, and you'll get a link to many, many different calendars. First is the economic calendar that we'll take a look at. Now, we have construction spending, ISM, the construction spending that was not as bad as expected. But what I'm really focused on is what's coming out at the end of the week, would be the jobs report. But I know, Kevin, that you're following some of the information that's coming out throughout the week. What are you especially paying attention to?
Definitely. So I would say, obviously, I do look at some of the crude oil inventory numbers that are going to be coming out on Wednesday. But as you said, the real big focus for me and what I'm actually looking at this week is going to be not only the initial claims, but the continuing claims. So the continuing claims number, I think, is going to be the all-star. It's going to be the really big focus, because we are starting to see a downward trend from initial claims. So we're seeing that a slope in initial claims each week, which could be a positive sign, but you want to also have that reinforced with the continuing claims also going down, which could indicate people are going back to work, because we shouldn't see a lot of individuals that have claimed unemployment within the last month and a half. They shouldn't really fall off the rolls as of yet. So it's going to be an interesting week to be able to see what those job numbers are going to really look like. But those are really the indicators that I'm looking at for this week. How about yourself?
Yeah, I'll be paying attention, as I said, to the jobs report on Friday, but also US auto sales. They're going to be coming out on Tuesday. Let me move it up to Tuesday so you can see it. And I saw something interesting from TrueCar. They do forecast that US auto sales will fall 32.1% in May. And retail sales are expected to be down 21% during the month, and fleet sales are expected to fall 78%. And we just saw that, Hertz Rent-A-Car is declared bankruptcy, and a lot of the other rent-a-car companies are suffering because a lot of people rent cars from the airport and people simply are not flying. Now, hopefully, that trend will change as we head into the new year. But right now, it's going to be tough on cars. And I was just looking at their estimates by manufacturer, and they expect, for instance, BMW to be down 43% in sales. Fiat Chrysler, they expect them to be down 43%. Ford down 37% in sales. And so the numbers are just quite staggering. Now, when it comes to the jobs report that you were talking about, some of the numbers that I'm seeing is that the unemployment rate, for instance, Refinitiv is expecting an unemployment rate of about 19.7%. So when it comes to the actual, numbers, it looks like we lost 8.3 million jobs last month. And then in the month of April, we lost 20.5 million jobs. But as you stated, it looks like those numbers will still be large going forward throughout the summer, but they won't be those same numbers. They won't be growing. So the marketplace is right now taking that as, currently a positive. And that is, of course, we don't have to shut down the economy again. But President Trump did say that, if the virus does come back, and many governors are saying this too, that we're probably not going to go through, another shutdown. All right, so that's the calendar. Let me just share with you what's going on. Let me go to our earnings calendar. The earnings calendar is that next tab. And you could see what is coming out before the open, after the close. We also list it by market capitalization. We are at the end of earnings season. Over 95% of companies have reported earnings according to FactSet. Now there are 11 S&P 500 companies reporting this week. And of those 95% that have reported, 64% have reported positive earnings surprises, and 57% of S&P 500 companies have reported positive revenue surprises. Now for earnings growth, the thing is, when you take a look at all the S&P 500 companies, it looks like the number will be that earnings are down 14.6%, which is the largest year-over-year decline since the third quarter of 2009. And at that time, it was a higher number. So it was down 15.7%. So this is the highest number since the Great Recession. Now let's take a look. What I wanted to show you, and we'll come back here at the end of today's session, I wanted to show you a couple of the stocks that are coming out with earnings, and maybe we could take a look at what the options marketplace is pricing in for a potential range of movement. So I thought maybe we could take a look at, let's see, Dick's Sporting Goods. And I thought maybe we could take a look at Zoom or CrowdStrike. These are bigger names. Maybe, Kevin, we could have our attendees pick one of these stocks, or maybe you could pick one of them. And then I was also fast forwarding to, I'm interested in Broadcom. They come out Thursday after the close, because I do like to follow the semiconductor industry. So what are you thinking?
Let's take a look at Zoom. I mean, we've seen a lot of talk about the company for the last 2 to 3 months, and we see a continued push in the stock price. Even today, we are seeing Zoom up a pretty significant amount, up about 13% just on the day alone. They did reach the $200 price point, which is a major milestone for them. So curious to see how the
Right.
marketplace is actually pricing in the earnings for them.
And they haven't been around very long. We'll take a look at the chart. I'll talk about some of their past moves and what the marketplace is currently anticipating. Now, when it comes to looking ahead, when it comes to the second quarter, the FactSet does expect earnings for the S&P 500. They expect earnings to drop 42.9%. And the sectors most impacted will be energy, down 150% for their earnings growth, then consumer discretionary, industrials, and financials. They expect those four sectors to be actually losers. And, well, I should say actually, they expect those to be the worst losers. They expect all of the other sectors except utilities to have losses, and they expect utilities to be up 0.3%. So it's going to be a really, really tough second quarter. Now let's take a look. Let's go back to, let's take a look at the Dow. And we could see which stocks in the Dow are the biggest movers today. Here's the Dow. Now you can see it has not broken through the 200-day. See that? We're still a bit a ways, but right now it is sandwiched between the 20-day and that 200-day. Now, what about let me take a look at the watch list. So what are you seeing here on the Dow?
Definitely. So we're seeing It's an interesting type of rotation that we're actually seeing in the Dow. We saw a little bit of a sector rotation Wednesday and Thursday of last week, and today it's really showing that same type of trend. We're starting to see a little bit of movement into the energies, industrials, and the financials, and you're seeing a little bit of a sell-off within healthcare and information technology or communication services. The biggest sell-off today is going to be Pfizer. So Pfizer is down about 6.9%, almost 7%. They did have news that they had a drug trial. Actually, it was, I believe, two drug trials that seemed to not do so well. So that's caused them to have a significant sell off. But overall, I think the trend of a sector rotation is still taking into effect. And I think that's why we're also seeing the markets when we're making moves. If we saw Thursday, Friday, and then today, we're seeing moves of about a quarter of a point to a half a point in the SPX each and every session. Whereas before we were seeing a lot larger trends of
Hmm.
you know, 1.25% to 1.5%, and I think the reason being is because of the sector rotation. You're moving it into sectors like energy, which has a fairly low beta compared to say a sector like communication services or technology. You're also seeing a movement into industrials, once again a little bit lower beta than some of those other names that we have already discussed. And so we're seeing this occur. And a sector rotation, though, is a good thing to see, though, Nina, right? You don't want to have too much concentration into one sector. And it's nice to see that the healthcare and the consumer staples were able to push the market up higher. And, but that lack of diversification, you want to see that money move into other assets and other sectors like health, like consumer discretionary, financials, and energy, and then also seeing a little bit of a sell off within the treasury market as well. Because if we see treasury selling off, it means investors are looking for a little bit riskier assets, which equities is right in that alley. So hopefully this rotation continues, but just very interesting to see. I know we'll probably talk about the VIX here in a little bit, but the VIX is still pricing in about a 1.7% daily move, and we've only been seeing about 0.5% moves on these days. Now, the intraday swings have been a little bit interesting. I think on Friday we had a pretty interesting intraday swing, but all in all, we're still seeing some modest gains compared to the last 2 to 3 months.
And the sectors last week that outperformed, they were the financials in the S&P 500. The financials were up almost 8%, 7.9%. Industrials were up 6.7%. So last week, they were definitely the leaders, with utilities and materials just right behind. All right, let's take a look at the NASDAQ. And we have been, we've been well above the 200-day. So we crossed above the 200-day. Let's see, how far ago? That was way back in April 21st, we closed above the 200-day. So that's about 6 weeks ago. So when it comes to the NASDAQ, what's one of the reasons why it looks like we're going to, get very close to these all-time highs? What's one of the reasons?
A lot of the stocks that are within the Nasdaq, they have a lot of, obviously they're technology companies, they're more technology based, so they have a lot more opportunities that are out there. But we're also seeing a little bit of rotation, as we talked about earlier. The
Hmm.
leader in the NDX or the Nasdaq 100 is Marriott at this point in time. We're seeing Marriott, Tesla, and American Airlines. So we're seeing the airlines actually move up from historic lows, and we're continuing to see Tesla make gains. They're almost going to hit $900 again, $900 per share, which is very interesting. And then you're also seeing a couple of these other names that did have pretty significant sell-offs going into COVID. So Expedia, you're looking at Booking.com. So a lot of those discretionary stocks are starting to catch a little bit of a bid. So we're seeing still a rotation, even within the NASDAQ, we're seeing a rotation. I think we're just seeing a little bit of a greater rotation in some of these larger market cap type of names uh, that were really beat up going into the sell off of COVID at this point.
Yeah, definitely the stocks that point to, a stronger reopening of the economy have been doing well. Now, personal income did jump did actually jump, even though we had they showed last week that we had the biggest monthly decline in U.S. consumer spending. But personal income soared, and one of the reasons is, even though people were unemployed, it's the stimulus checks that did help. And the national savings rate did hit a record high. People are saving 33% of their checks that are coming in, which, and we have, we haven't seen these numbers. And in fact, during the Great Recession, people saved more money, but nothing close to those levels that we saw for just this short period of time. Probably, that money will start to definitely, sounds like it's going to be spent over the summer as people start to figure out their plans, um, for maybe taking local trips or visiting. It sounds like a lot of people are buying RVs, and they're making plans to see America and to go to state parks or national parks. So, what about you, Kevin? Are you making any plans for a short or quick getaway?
We are. So we're trying to plan a trip to see America, like you said. It'll be kind of the first big road trip that we do, but that is the reasoning for doing so. There's still continued fears that are out there when it comes to not only just taking a flight somewhere, but also having to uh, dealing with the airplane, dealing with the rental car, dealing with the hotels, all of those environments. You're trusting somebody else to make sure that they're clean, sanitary. You're not sure who's been there before you. So, in order for us to continue to minimize our exposure, we do plan on taking a road trip, and where we drive and go see family members, see friends, see the country. And everybody that I've talked to, they're pretty much doing the same thing this year. So I haven't heard of anybody that's really taking any international trips at this
Right,
point in time.
right. This time last year I was in Italy, and so it's I'm definitely not going to be doing any international trips for quite some time. I'll probably stay very local and go to Wisconsin or Michigan, something like that. But probably it will be more like September. Um, all right, let's take a look at crude oil. Here's crude oil, and I read an interesting report. Reuters did a poll of 43 analysts, and they asked them, where do they think the price of oil will be throughout the year? And according to their poll, these analysts feel that crude oil is very unlikely to break 40 bucks. And when they surveyed these 43 analysts, they said that crude oil will probably average $32.78 in 2020. And one of the reasons why they feel that crude oil, won't pop is also this just renewed tensions that we do have with China over their handling of, let's say, COVID-19, also what's going on in Hong Kong, and also just the continuation of our fate, that we had that phase 1 deal. Will all of the, contracts, will all of the, what they negotiated, will it all go through as planned? And so, that was quite interesting to see, but many times, what analysts say, they're often, economists can be, of course, wrong. I was at a Federal Reserve conference in mid-December, and they asked, actually, it was about 200 analysts there, where they feel crude oil will be on average for the entire year of 2020. And it was around the $52 level at the time. And so as you could see, but we've rebound quite a bit from Black April, from the lows that we had in April when the May contract went went negative, as we witnessed it live as it went negative. Remember that?
Mm-hmm.
Yeah.
Yeah.
Now the EIA, they did show that the US is has a weekly decline of 100,000 barrels a day in total oil output, and it's now 11.4 million barrels a day. And they were pumping about 13 million barrels a day not too long ago. And OPEC in May, they were pumping 24.7 million barrels a day, and that's down almost 6 million barrels a day from the April figure. So OPEC is cutting back. What is that? 20. They cut back 20% just in 1 month. Now, when it comes to crude oil, what levels do you see here that different support and resistance levels?
Yeah, so for crude oil, I would probably say the lower band for me is going to be that 50-day moving average. It's going to be around $28. But I am going to be a little bit more optimistic. I would say maybe a $42 per barrel price is realistic. Reason being, we may have some China tensions out there that might hamper demand and might hamper everything. But we've seen a lot of moves on the supply side, as you've already said. So we're at almost a 20-year low when it comes to rig counts. We only are operating about 220 rigs in the U.S. At this point in time, which is, like I said, it's only about 44 rigs away from the 20-year low at this point. OPEC does sound like it may also double down and extend some of these cuts as well throughout the year to try to find some price stabilization. So, and there's a lot of different things that could happen when it comes to the election and just geopolitical items as well. So I'm going to give a little bit more of wiggle room and say maybe a $42 price point is not out of the question at this
For
point in time.
later
But
in the year,
yeah,
isn't
I would
that?
say, yeah, from now for the next 6 months, I could see a range. Let me put it that way. I could see a range between 42 and 28, continued range between those levels at this point. I could see us hitting the $40 level though. Just overall as we see more cuts. It's just we have such a small window though, Nina. We have such a small window right now for consumer demand. I do believe that once we get to October and November, maybe some of the audience members can also chime in on this. Maybe I'm wrong or off base, but once we start getting to October, I know that my family is doing this. I've heard others as well. We're gonna probably not only we're gonna act like the COVID-19 virus is still a big problem. So we will live our lives in a more secluded manner to try to prevent another secondary spread over the wintertime. So what does that mean for myself and what does that mean for other consumers? That means you are going to spend less. You're not going to spend as much on leisure, hospitality, things of that nature. You might tighten the bootstraps a little bit. So I could foresee that maybe a lot of consumers might do that just of a fear of a second spike, and it could alter overall consumer demand. Uh, so there's a little bit of a small window for crude oil as far as overall demand is concerned. That's just my take on it at this point.
Mm-hmm. I've got a, just I also talk to, coworkers, and I would say across the country, it really depends upon where you live, your level of concern. For instance, people who live and work in New York City, let's say in Brooklyn, you know, they're more concerned. I'd say people who live in, areas that are still urban, but they're more spread out. Like if you're in, let's say, near Indianapolis, you're not as concerned because their levels of infection and deaths have been lower. So I would say the level of concern definitely does vary around the country. I've been concerned, but some of my friends not as concerned. It just really depends, seems to depend upon the individual. So. But definitely this year, we've got a lot of headline risk. The China tensions will probably continue to bounce, back and forth. The coronavirus will continue to be a major headline. And then don't forget, we've got the election coming up in November, and that will start to really, be as we head into the conventions this summer. That will take up a lot of the news, a lot of the news out there. Now, I thought we could take a look at, so this is crude oil. Should we take a look at any other products you wanted to take a look at?
We can look at gasoline. So the June contract or the July or the sorry, the July contract for gasoline, the RBN20.
That is right. Hold on a second. Do I got that
And the
right?
reason why I'm trying to see if there's going to be more of a correlation when we see gasoline compared to crude oil. We used to, about a year to 2 years ago, we saw a really, really strong correlation between gasoline and crude oil, but we did see a formalized break of that earlier this year, where gasoline was able to have a little bit of a, stabilize itself a little bit, but crude oil itself really just impacted. Crude oil just didn't have as big of an impact on gasoline demand as I would have thought. So I'm actually interested to see the gasoline demand for this year as we go forward, not only as the consumer goes out and starts to travel more, as we see more drivers on the road, but some of the other utilities that are out there that are going to be ramping up because of maybe the seasonality of the weather at this point. I mean, we still do have a forecast of this year to have, pretty significant weather discrepancies or changes, especially when
Like
it comes
natural
to
gas?
the, yeah.
Wanted to
So
check out natural gas?
yeah, we could check out natural gas, but when we're looking at some of these products like natural gas and gasoline just alone, I think that we might still see a little bit of upside when it comes to these products. So natural gas, obviously, we see a little bit of sell off,
Hmm.
and it hasn't really been able to find its bottom yet. But I think that we are going to see an indication of the overall consumer demand moving forward as we see these prices continuing to potentially go up. And if we do see them go up, we might see a little bit of a break between crude oil itself and just these
Yeah,
products
because the
alone.
the natural gas it's a little bit different than crude oil,
Right.
because when it comes to natural gas, like the you know the weather plays a big role, especially in the winter time. So if it's cold, that would be a big catalyst for more demand for gas. And so weather plays a big role versus when you have a shutdown. Natural gas wouldn't be as impacted. But they do say when it comes in general to, let's say, electricity usage, that it depends on the state that you're in, but because everybody's working, well, I shouldn't say everybody, let's say 30% of people are now working from home, that, they're not working in these, big offices downtown, and that could be really hard on the suburban grid, the suburban electrical grid. And they're saying that there could be some brownouts in it once it gets hot and people put on the air conditioning, everybody's home when they didn't used to be home every day, that some states like Texas could actually have some potential for brownouts. So great, we have to now add that to our list of worries, Kevin. So add that on there too. All right, because it looks like I'll be working from home for a couple of more months. What about you, Kevin? You're out in Denver.
Yeah, I plan on working from home. I'll probably start a little bit of a balance of working from home and going into the office as well, because there's just certain things that I want to get back in the groove of doing, to be honest with you. But overall, I think that's going to be the majority of those of individuals that can work from home. They probably are going to leverage it. It has been very helpful when it comes to childcare in my situation. So I'm sure a lot of other consumers and people out there do enjoy that flexibility. But also being able to go in the office as well is going to be nice to try to start up a little bit of a routine. So I'm going to be a little bit half and half, but I will be safe when going into the office space. Wearing mask all the time and making sure
Hmm.
we're social distancing is still going to be key.
But it's definitely, we won't be able to do it when we're doing these webcasts. It would be
Right.
tough to do. So, all right. So I thought we could take a look at how the options marketplace is pricing in for a potential range of movement for some stocks that are coming out with earnings. And Kevin selected Zoom, and that is now one of the stay-at-home favorites for many traders. Let's take a look at now, the thing is, this stock has not been around very long. So they're coming out with earnings. And once again, whenever you're putting on an option strategy, make sure you know when the earnings are. That way you're not putting on the strategy and crossing into earnings when you don't want to. Or if you do want to cover earnings, you could pick the wrong expiration that expires before and you won't be bumping into earnings. So in this case, earnings are going to be Tuesday after the close. Make sure you do the research, look up if it has a Schwab equity rating, check that out. Check to see what other analysts have to say about the particular stock as well. But what I'm going to talk about is just, how the stock has reacted before and after earnings in the past. Now, the thing is, past performance isn't, you know, doesn't signify how it's going to move in the future. But the thing is, a market maker has to start somewhere. They have to go look at the past to see, well, how could this maybe react if the news is good or if the news is bad. But another thing is, though, with this particular stock is that it has not been around very long. The stock was listed in April of 2019. So it's been around just over a year. And so when I was trading on the floor of the CBOE, I also was on the stock selection committee. And at first, we wouldn't list stocks that have options unless the stock has been around for 2 years. We wanted 2 years of pricing information. And then, through the years, that's changed. They kind of threw that out the window because there's been just so much interest in a lot of these stocks that are recently listed that sometimes you can get options, a couple days after the listing. I don't know now what the shortest time frame is, but it's pretty close. At first, it was like a month. Now it could be very fast if there is interest. So the issue is many some traders don't want to make markets in something that hasn't been around a while. They kind of have a hard time gauging how volatile is this thing going to be on a regular day, let alone earnings. So when I was on the floor, I would trade newly listed stocks. However, some old timers in the pit wouldn't necessarily do it. They would jump on later after there's more price history. Now, when it comes to Zoom, this particular stock has been a mover. But the thing is, there's not 2 years of pricing information to look at, even. We've just got what, 4 earnings listed here. And over these 4 earnings, this stock is a mover. I mean, it's been moving almost 11% on average. Not every time, sometimes a bit more, sometimes a bit less. And that's the thing. Make sure that just looking at an average move, you know, just looking at an average move isn't always helpful. Look and see what the actual moves have been in the past, because that can help give you a better picture, because when you get averages, it smooths out the information, right? It smooths out the very good and the very, very bad. And so that means that on average it's moved 10.8% up or down, up or down. Now let's look to see how the options marketplace is pricing in for a potential range of movement. So let's go and actually let's talk about volatility. let me overlay volatility. So Kevin, can you talk about, let me put it on the actual stock chart too. Can you talk about implied volatility and what happens to it over time?
Sure. So implied volatility is exactly really what it sounds like. It's the implied move or the implied volatility or market movement of a stock. So when we actually see a earnings announcement that comes up or a event for a stock, you'll actually see the implied volatility increase. You're seeing the expected move. The market is expecting the move of the stock to be significant. Now, once we have the event, you will typically see the implied volatility actually go lower because the event is already done. The information has been disseminated to the marketplace, and we as traders are able to uh, consume the information and be able to try to have the correct price discovery. So this is really the trend that we see when we look at earnings, and I know it's very, very popular for us to talk about implied volatility when it comes to earnings, but it doesn't just have to be earnings. It could be a trial, decision from a judge regarding a new vaccine on the marketplace. It could be any type of event that's very important to a company. But overall, that's where we are seeing this implied volatility come into effect. So we're seeing a little bit of a spike in implied volatility for the stock right before the earnings play at this point.
And the thing is, today, on a non-earnings day, now this isn't in anticipation of earnings, but it's up almost 24 bucks. That's 13%. So you could see this giant, we're at all-time highs right here. We're above 200 bucks. So it had this gap up. Now let's look and see what the options marketplace is pricing in. Let's go to the chains. We're going to look at the shortest time frame available. In this case, we'll look at the options where the last trading day is June 5th. We're going to look at the at-the-money straddle. We could look at the 200 call or the 205 call. Let's look at the 205 call. It's trading, we're looking at the fair value of the straddle, the midpoint of the call added to the midpoint of the put. We get about 29 bucks. And with it trading 200, the marketplace is pricing in for about a 15% move from now until um, Friday. Okay, I should a 15% move. I should say. Well, the straddle is most of it is for the volatility. Most of the volatility is priced in for this 1 day move, but keep in mind that we do have additional days after the announcement. So earnings come out Tuesday after the close. We have all day Wednesday. We also have Thursday and Friday. So we have 3 days after the announcement. So that is priced into the straddle as well. So let's say about 80% of the straddle is priced in for the earnings event. So the marketplace is pricing in, for, maybe like a $23 move possibly, you know. So another tip that you could do is you could take a look at the volatility of the at the money straddle, the at the money options, and the marketplace is pricing in for almost a 10% move. So you take the current implied volatility. Let me show both the call and the put. The marketplace is pricing in for 150 volatility. That's an annualized number, but you could break it down into different time frames. And if you just wanted a 1 day time frame, it's pricing in for almost a 10% move. You would take that volatility and divide by the square root of time, which is in this case the number of trading days in a year. So the square root of 252 is about 16. So you take 152 divide by 16, you come very close to 10%, which is a little over a $20 move. That's what they're pricing in for earnings. But the thing is, it moved this much right now. So if you put on a strategy earlier, let's say on Friday or earlier, um, let's say you put it on Friday into earnings that's bullish. I mean, the strategy might currently be working for you, and if you bought options, bought a spread, or bought an individual option, well, you do have time decay working against you, but the thing is the volatility didn't drop just yet. You had the stock make quite a big move even before the event. So it's something to think about. Definitely something to think about. Whether or not to take the whether or not to take a strategy off if you put it on that far in advance and it works out for you. Now, Kevin, do you ever, when you put on earnings plays, do you put it on the trading session before?
It depends on the stock, if I'm going to put it on before. So sometimes with the technology stock, I'll actually wait till the day of. Even though I
Mm-hmm.
know that the implied volatility may be a little bit higher, a lot of the earnings plays are really, I'm not really buying long calls or long puts. Typically would just do some spread strategies. So even though I do know that I'm going to have a higher implied volatility, I'm trying to offset that higher implied volatility by selling either a call against my lower strike price call, or selling a put against my line long put. So still trying to spread off the strategy. That's only if it, like I said, it just depends on certain sectors. And this is actually the reason why, if I was actually putting on a trade for Zoom on Friday, yes, it's actually moving in its direction if I'm bullish today, but you are faced with that dilemma of, do I want to take it off before the actual earnings announcement and take my profits, or do I want to hold until the announcements happen? That's always a dilemma that every trader has faced at one point or another. So for myself, I try to see what the actual stock is doing the day of earnings, and if there's an opportunity for me to capitalize on a particular trade, I might establish a trade. And if not, if I think that the stock may be overpriced at the time of earnings and the options marketplace is showing a really large expected move, I might shy away from actually putting on a strategy altogether. Just kind of depends on my comfort level.
Right. I mean, I typically would do the strategy the day, the trading session before the announcement, because
Mhm.
sometimes the stock can move and then your strategy's out of position.
Right.
Now, if you were bullish, your strategy could be even a better position. But what if were bearish and you sold the call spread? Now you've got this strategy working against you. And it, and and the move will be based on, in the end, where the stock closes on that last session, not where it was, a couple days ago. All right, great. And Tom, I'm not quite sure if you could rephrase your question, because I'm not quite sure what what the question is. If you could rephrase it quickly. But let me show you. We do have Liz Ann Saunders coming on. She's going to be on Liz Ann Live with Joe Mazzola. And if you go to schwab.com, then Insights, you could see the latest market commentary. You could go to new and featured, for instance. And so, as part of your homework before the session starts in about half an hour, you could read through her Connect the Dots, Main Street versus Wall Street. And then you could ask any questions live. So, once again, that's going to be later today in just about half an hour at 4:30 Eastern, which is 3:30 Central. All right, well, great. Once again, Kevin, I would like to thank you for joining me on closing remarks. And we look forward to having you later this week, too, on closing remarks.
Yep, Nina, it's always a pleasure. I hope that you have a great week, and I hope everybody stays safe out there.
All right, take care. Bye bye.
Hello and welcome to the Quick Start video for layouts in Schwab's Street Smart Edge platform. Layouts in Street Smart Edge are different views you can create to help organize your workspace. They are conveniently displayed in tabbed format with up to 8 layouts able to be open at one time. For example, rather than trying to fit all the research tools you use plus trading and account information on one screen, You can create one research layout and one trading layout and flip between the two. The possibilities for organizing your work area in Street Smart Edge are extensive and designed to meet the needs of a variety of trading styles. With Street Smart Edge, you can create your own layout or choose from our predefined layouts. One predefined layout is the account layout. This layout provides tools to help traders monitor their accounts and includes two account details tools showing order status and balances, a My Positions watch list, symbol hub, and messages. Another predefined layout is the Screener Research layout. Designed for seeking and analyzing potential trade opportunities, this layout includes the following tools: Screener Plus, News, Research, and Notes. The last predefined layout is the Trade layout. Designed to help make the trading process efficient, this layout includes the all-in-one trade ticket, news, chart, watch list, account details, and messages. Once your layout is the size that you want, add tools from the Launch Tools menu. Remove tools by clicking the X in the upper right corner of the tool. Expand or contract the size of a tool by moving your mouse over the edge or corner of the tool until you get a double arrow. Then click and drag until it's the size you want. You can move tools by clicking in the title bar of the tool and dragging it to another spot in the layout. Edges of the tools are magnetic and will snap together when they are placed close to another tool. What about linking? With Street Smart Edge's tool link icons, when a security is changed or loaded into one tool, all other tools with the same link icon will automatically update to reflect the symbol change. Here's a tip for those of you that use multiple monitors. You can undock layout tabs from the primary window by clicking on a tab and dragging it outside of the primary window area. Let's talk about saving layouts. Whether you started a layout from scratch or you tweaked an existing predefined layout, you may rename the layout and save to either the local computer or to Schwab's server. Remember, up to 8 layouts can be saved to the Schwab servers. This concludes the Quick Start Guide for layouts for Street Smart Edge. Please check out the Learning Center and the online help manual, both of which are located under the Help menu. Additionally, you can visit the calendar on schwab.com/live for a schedule of upcoming live platform videos. Thank you for choosing Charles Schwab and have a great day.
You could think getting commission-free trades is as good as it gets, but you know better. At Schwab, free means more. You get commission-free online trades, plus quality trade executions on our powerful platform. All from the only firm that offers a satisfaction guarantee. Expect more from your firm. Trade up to Schwab, the better place for traders.
Average true range, or ATR, is a technical indicator that can tell you how volatile a stock has been on average over a specified period. ATR is particularly useful for setting exit levels as part of your risk management strategy. It can also give you a sense of how strong price moves are, which is helpful if you're trying to identify the start of a trend. In short, ATR takes a holistic look at a stock's price moves over a...
Some of the data points that will be coming out this week on the economic calendar. We will cover some of the key indicators to be paying attention to this week. And then, as always, we'll be covering Liz Ann's article. And as I mentioned, that is called Disconnect the Dots, Main Street versus Wall Street. If you're looking for a copy of that, let me show you where to find it, right here on schwab.com. Here it is, our June 1st, 2020 edition, Disconnect the Dots, Main Street versus Wall Street. You know what? It's always nice to play at home, bring this up, and then that way you can kind of go through some of the different charts as we discuss them in our own discussion here. Okay. Well, listen, let's start off and talk about, first of all, some of the focal points of this week. We talked about this idea of kind of the internal discord, what we see happening here in the U.S. over the weekend and continuing through the week here, protests, curfews, shutdowns. mean, at some point, it seems like that has to kind of matriculate into the economy. It doesn't seem like it's, maybe going to be a short-term thing. I don't know. We will see. But between, as we mentioned, kind of the China-U.S. relations, there's a lot going on right now that is providing what, at least in my mind, I would expect to be kind of a headwind towards the market, but yet we just keep chugging along, don't we?
The market has been really extraordinarily resilient in what has been obviously an incredibly sad and trying time for the world the last couple of months, and in addition, obviously, the last few days in the case of the U.S. So one of the best quotes from Dr. Martin Luther King that I saw in all the various references for obvious reasons back to that time was, "A riot is the language of the unheard." And I think there's a lot of soul searching that's happening now in this country, and it should be. And it's just sad the timing, of course, of this coming when we're just trying to get our feet back on the ground and the economy opening back up. And yet again, we're sort of given this shock to the system and this catalyst for whatever reason. And I think some of the resilience of the market, and it's what I write about in the report today, is somewhat explainable by virtue of the history of how bear markets and recessions tend to correspond to one another, the market as a leading indicator, but of course the massive and unprecedented sort of volume and speed associated with what the Fed has done and what the combination of Congress and Treasury has done in kind of bridging the gap for consumers, for workers that have been laid off. And now I think the markets hope that we're going to look through the valley and that the recovery is going to happen in relatively short order. And I do think that given how resilient the market has been, and now some complacency, quite frankly, that is starting to show itself. I'm concerned, much like I was and wrote about at the end of January, that in an environment where investors become highly complacent, that's when you set yourself up for some volatility or some downside if you get a negative catalyst. And unfortunately, there's a growing list of potential negative catalysts here, some of which are already coming to fruition.
Yeah, of course. And let's mention a couple items on the economic calendar this week to keep an eye on. Well, first of all, we got a lot of central bank meetings, right, between the ECB, the RBA, and the PBOC. There's going to any wild cards you're expecting there?
No, we've already seen additional fiscal stimulus come via the European Central Bank. That was a pleasant surprise on the upside. I think now what will be watched for is any further signaling or any signaling that suggests that central bank authorities are sort of stepping away from being sort of full force in stimulus mode. I don't expect that at any point in the near term, but I think that looking ahead, that's potentially a risk. At what point does the Fed or other central banks say, okay, now we sort of need to step back and start to let the economy start to operate under its own, motor?
Yeah. On the calendar, we have, we had, the ISM Manufacturing Day came in at 43.1. Well below the contraction of 50, a little bit below expectations of 44, but we do have some other numbers coming out this week as well. We have ISM Services, or the non-manufacturing, on Wednesday, and then the initial and continuing claims on Thursday. Is that more of a, we're looking kind of for the delta there? I mean, I'm assuming we're expecting to see that continue to go up, but at some point, are we looking for a better than expected as a bright spot?
Yeah, I think that's in general what the focus has been and will continue to be on economic data, particularly the higher frequency economic data. You could argue you saw it today with ISM Manufacturing. It upticked. It's still in level terms at a terrible level, but it was the first uptick in 4 months. You saw claims on a weekly basis, start to improve. Still